The global commodity market just experienced a sudden, violent structural repricing. For months, investors treated copper as a pure-play proxy for the artificial intelligence boom, driving valuations to historic premiums. But a sudden correction in megacap technology stocks has triggered a deep liquidity cascade. As chip makers pulled back, copper plunged alongside them. This unexpected correlation caught the street completely off guard. It reveals a fundamental tension between physical industrial capacity and digital infrastructure valuations. To understand this dynamic, we have to look at the primary institutional vehicle for copper exposure. Freeport-McMoRan, ticker FCX. Freeport operates some of the largest, lowest-cost copper assets globally. Their core moat isn't just about raw extraction. It's about their unique scale in refining highly purified cathode copper. This material is absolutely essential for heavy power grids. Without Freeport's supply, the massive computing infrastructure planned by technology giants simply cannot connect to power. This positions the company at the very foundation of the modern structural energy transition. Freeport's premier asset is the massive Graberg district in Indonesia, alongside world-class operations in North America. This geographic diversification acts as a crucial shield against rising resource nationalism. While competitors struggle with regulatory gridlock in South America, Freeport enjoys stable operating environments. Their proprietary leaching technologies allow them to extract copper from historic waste stockpiles. This provides a low-cost production pipeline that standard mining firms cannot replicate. It's a structural advantage that cushions their margins when spot prices experience short-term volatility. But that is only part of the story. Here's where the margin metrics become interesting. In their latest quarterly reports, Freeport demonstrated exceptional operational resilience. Even as market spot prices fluctuated, the company sustained a strong EBITDA margin of nearly 45%. Their consolidated sales volumes reached over £1 billion of copper. Crucially, net cash flows from operating activities surpassed $2 billion. This robust cash generation allows them to fund internal capital expenditures without taking on high-interest debt, separating them from highly leveraged peers. Now look at how these financial statements connect to the broader market. Freeport's revenue sensitivity remains highly levered to global economic shifts. For every 10-cent move in the price of copper, their annual operating cash flow shifts by over $300 million. That massive operating leverage explains why institutional capital closely tracks daily copper pricing. When tech valuations began to wobble, algorithmic trading models automatically triggered risk-off sales in Freeport. This sell-off was driven by short-term sentiment rather than a deterioration in the company's actual balance sheet. The next signal comes from management's capital allocation strategy. During recent earnings calls, leadership emphasized disciplined capital stewardship over aggressive output growth. Instead of chasing expensive corporate acquisitions, Freeport is focusing on high-return organic projects. They are prioritizing brownfield expansions where infrastructure already exists. This approach significantly reduces execution risk. Management is clearly sending a signal to the street. They value balance sheet strength and dividend sustainability over raw volume expansion, protecting long-term shareholder value in a highly cyclical industry. This conservative management strategy directly influences forward guidance. While some analysts expected Freeport to forecast aggressive capacity additions, management chose a more cautious path. They projected steady, controlled volume targets for the next fiscal year. This deliberate pacing ensures they avoid costly capital overruns during periods of supply chain tightness. It also highlights their focus on preserving high unit margins. By maintaining a tight supply discipline, management is positioning the company to benefit immensely when the physical deficit in the copper market inevitably widens. To understand why this is happening, we must look at the broader macro environment. Copper is facing a complex crosscurrent. On one hand, traditional industrial demand from China's property sector remains sluggish, weighing on spot prices. On the other hand, the secular demand from global electrification is accelerating. Advanced power grids, electric vehicle infrastructure, and heavy industrial machinery require vast amounts of high-grade copper. This dual reality creates a stark divergence between short-term cyclical headwinds and long-term structural tailwinds. The most critical driver of this electrification thesis is the rapid expansion of artificial intelligence data centers. Companies like NVIDIA and Microsoft are investing hundreds of billions in advanced computing clusters. But these cutting-edge servers require massive amounts of electrical power to operate. This power must be delivered through high-voltage copper transmission lines and specialized transformers. This reality creates an absolute floor for copper demand. Even if software valuations pull back, the physical build-out of the digital physical layer remains a multi-year structural necessity. That leads us to a bigger question regarding terminal risk. No investment thesis is without its vulnerabilities. Freeport faces persistent cost inflation, particularly in energy and specialized labor. Mining operations are inherently capital-intensive and highly sensitive to fuel prices. Additionally, regulatory pressures are intensifying globally. Governments are demanding higher royalty payments and imposing stricter environmental standards. These headwinds could compress operating margins if copper prices remain suppressed, challenging Freeport's ability to generate excess cash flow. Beyond operating costs, the primary near-term threat is systemic market correlation. When global stock indexes experience sharp sell-offs, highly liquid commodities like copper are frequently used as funding sources. Institutional desks liquidate commodity futures to cover equity losses. This correlation means Freeport's stock price can decouple from its strong underlying fundamentals during broader market corrections. Investors must accept that short-term price discovery is often dominated by macro liquidity flows rather than physical supply and demand balances. Despite these near-term risks, the long-term outlook remains highly constructive. The structural deficit in global copper supply is projected to widen significantly by the end of the decade. Major mining houses like BHP Group have openly acknowledged that discovering new Tier 1 copper deposits is becoming incredibly rare and expensive. This supply-side constraint, coupled with inevitable demand from the energy transition, underpins a robust multi-year investment thesis. Freeport's existing, low-cost asset base positions it as a primary beneficiary of this looming physical supply crunch. This brings us to a major valuation reassessment. The current market correction represents a healthy flushing of speculative premium. As short-term traders exit, institutional capital has an opportunity to re-evaluate physical assets at more attractive multiples. Freeport's valuation has compressed to a level that underrepresents its long-term terminal value. This divergence between immediate equity sentiment and long-term commodity demand is where sophisticated investors can find substantial value. The structural trend toward global electrification is far from over. For our tactical execution framework, we are placing Freeport on a breakout watch. We are closely monitoring the stock as it consolidates near major overhead technical resistance levels. A clean breakout on high trading volume would signal strong institutional capital accumulation. Conversely, tech leaders like NVIDIA remain on a trim consideration for portfolios that are overallocated to high multiple digital growth. Rebalancing capital from digital infrastructure into physical commodity assets like Freeport could provide essential structural protection during this period of market volatility. Navigating these complex macro rotations requires disciplined analysis and a long-term perspective. As the line between technology and physical infrastructure continues to blur, staying informed is your greatest edge. To keep receiving deep institutional research and strategic market analysis, subscribe to SR Money News. Turn on notifications so you never miss our deep dives into the trends shaping global capital markets. Thank you for watching, and we will see you in the next analysis.